Today, we're doing a complete breakdown of ASC 326. We'll cover the scope, core principles, measurement, journal entries, and real interview questions. Whether you're studying ASC, prepping for a Big Four interview, or working in finance, this is everything you need to know. Before ASC 326, banks often underestimated credit losses, leading to unexpected financial hits. For example, during the 2008 crisis, banks faced unforeseen billions in losses. ASC 326 requires a more forward-looking approach, ensuring banks account for potential credit losses upfront. Understanding this shift will reveal how ASC 326 transformed financial reporting and risk management. ASC 326 reshaped the accounting landscape by requiring earlier recognition of credit losses. Before its adoption, banks often recorded losses only when they were evident, leading to delayed responses in financial statements. This standard encourages a proactive approach, using current and forecasted data to estimate potential losses. This change not only improves transparency, but also strengthens financial stability by reducing the surprise element in loss recognition. ASC 326 impacts every entity with financial instruments, including banks and lenders. It became effective for SEC filers starting in 2020, with other entities following in 2023. The crucial requirement is the adoption of the CECL model, which focuses on estimating expected credit losses rather than incurred ones. This shift ensures that entities account for potential risks earlier, enhancing transparency and reducing financial shocks. The CECL model, central to ASC 326, revolutionizes credit loss estimation by focusing on expected, rather than incurred, losses. This approach requires entities to assess potential losses over an asset's life, using diverse data sources. In interviews, understanding CECL's forward-looking perspective is crucial, as it demonstrates an ability to manage risk proactively. This model enhances financial reporting's predictive power, aligning more closely with economic realities. Understanding the scope of ASC 326 is crucial. Candidates often miss that equity securities aren't covered by this standard, a classic interview trap. Knowing exactly what ASC 326 includes and excludes is vital for accurate financial reporting and to avoid costly mistakes. ASC 326 primarily focuses on financial assets measured at amortized cost, such as loans and receivables. Debt securities, whether available for sale or held to maturity, also fall under its purview. This ensures that expected credit losses are accounted for. For example, trade receivables must use the expected credit loss model, reflecting potential credit risks. ASC 326 excludes equity securities, focusing on debt instruments instead. Financial assets at fair value through profit or loss aren't covered, as their treatment aligns differently. Derivatives are also excluded, avoiding redundancy with fair value guidance. Short-term trade receivables, without significant financing components, are another exclusion, simplifying their treatment. These exclusions can trip up candidates in interviews. Credit loss under ASC 326 is the gap between what's contractually due and the cash flows expected. If a $10,000 loan is expected to yield only $9,000, the credit loss is $1,000. This forward-looking approach ensures that potential losses are recognized early. By accounting for expected defaults, this method aligns financial statements with realistic expectations and enhances financial transparency. Financial assets are defined by their values stemming from contractual claims. Bonds, loans, and receivables fall into this category, with their promise of future cash flows. The nature of these assets is central to implementing ASC 326's expected credit loss model. Accurate identification ensures businesses assess risks properly and manage assets effectively, maintaining financial statement integrity. Scope edge cases often trip up candidates. For example, financial assets and securitizations still on balance sheets fall under ASC 326. Credit card receivables also qualify due to their expected cash flows. Lease receivables follow different standards, so they're excluded. Loan commitments typically don't apply unless funded or meeting specific conditions. Knowing these nuances can set you apart in interviews. Imagine a bank that doesn't foresee future defaults in its lending. ASC 326 and the CECL model address this risk by requiring institutions to account for expected credit losses, ensuring financial statements reflect potential future losses. This proactive approach helps companies like banks remain solvent and prepared for economic downturns. The CECL model is a forward-looking approach to estimating credit losses, ensuring financial reports capture future uncertainties. We'll track Meridian Corporation, who just signed a $10 million SaaS contract with Acme Incorporated, including $8 million for software and $2 million for services. Follow how each step of CECL refines this scenario, ensuring accurate credit loss projections. Step 1 of the CECL model requires identifying all financial assets. For Meridian Corporation's $10 million SaaS contract, this means examining receivables for any potential credit losses. Ensuring the identification of all relevant assets avoids gaps in assessment. This comprehensive approach prepares us to estimate expected losses in subsequent steps, setting a solid foundation for accurate financial reporting. Determining expected credit losses means projecting future losses for financial assets. For Meridian Corporation's contract, we consider historical data to estimate potential defaults. Ignoring economic shifts often leads to inaccurate estimates. By leveraging historical, current, and forecast information, we calculate more reliable loss projections, preparing for accurate measurement in the next step. Accurate measurement of credit losses involves analyzing past data, current conditions, and future forecasts. For Meridian Corporation's contract, this means adjusting historical trends with present economic shifts. Relying solely on past data can mislead estimates. Ensuring comprehensive measurement provides a realistic view of potential losses, setting the stage for recognizing these losses in the financial statements. Recognizing credit loss means reflecting it in the financial statements. For Meridian Corporation, this involves recording the calculated losses from Step 3, directly impacting financial results. Delaying this recognition can distort net income and decision-making. Timely acknowledgement ensures that financial statements provide an accurate picture of potential liabilities, forming a solid base for updating estimates in the future. Updating credit loss estimates involves revisiting projections as new data and economic shifts occur. For Meridian Corporation, this means refining the previously recognized losses as conditions change. Overlooking updates can result in outdated financial positions. Regularly adjusting estimates ensures financial statements remain reflective of true liabilities, completing the CECL process by maintaining accuracy and relevance over time. The measurement method you choose directly impacts your balance sheet. A wrong choice can overstate assets by millions. ASC 326 requires careful evaluation of credit losses and clear disclosures to ensure accurate financial reporting. Understanding these options and their effects can mean the difference between compliance and costly errors. Recognizing and measuring financial assets accurately at the outset is crucial. ASC 326 demands that assets are recognized at fair value when control is obtained and collection is probable. The expected credit loss model is applied right from this point, ensuring impairments are estimated proactively. This initial step sets the tone for future financial accuracy. After initial recognition, financial assets under ASC 326 require ongoing review, focusing on credit loss estimates at each reporting date. If credit risk has significantly increased, the lifetime expected credit loss must be calculated. If not, only the 12-month expected loss is needed. This approach ensures that financial statements reflect current risk conditions, maintaining asset valuation accuracy. Financial statement presentation under ASC 326 is precise. Credit loss allowances must appear as a distinct line on the balance sheet, ensuring clarity and asset valuation. Interest income is separately recognized on the profit and loss, providing transparency. Detailed notes explain how estimates are calculated, helping analysts understand the underlying assumptions and methods. ASC 326 requires disclosing credit risk management practices, which reveals how a company manages potential losses. It's essential to outline assumptions and inputs used in estimating credit losses, ensuring transparency. Disclosing a reconciliation of credit loss allowances helps track changes. Explaining shifts in credit risk assessments provides analysts with insight into potential future financial risks. The role of a CFO under ASC 326 involves ongoing assessment of credit risk changes. Imagine initially recognizing an asset at $10 million with a $500,000 allowance for credit losses. Quarterly reviews then lead to a $200,000 increase in lifetime expected losses. Such adjustments are disclosed, offering investors insights into the entity's risk management strategies and enhancing confidence. Meridian Corporation, a global manufacturing company, signs a 5-year operating lease for its Singapore warehouse. Watch how every accounting event plays out. Each step reveals the intricate dance between ASC 326, financial reporting, and real-world business operations. See how these entries shape the balance sheet and income statement. ASC 326 requires the initial recognition of financial assets at their transaction price. Here, Meridian Corporation records a $1 million loan receivable as it issues the loan. This entry reflects the extension of cash and the expectation of future repayments, impacting both the balance sheet's asset side and cash flow statements. Under ASC 326, companies must recognize expected credit losses. Meridian forecasts a $50,000 loss on the supplier loan. Recording this as a credit loss expense affects the income statement, while establishing an allowance for credit losses on the balance sheet reflects the potential risk in asset recovery. Accruing $25,000 in interest income reflects the periodic earning from the loan under ASC 326. This entry increases interest receivable and boosts financial performance on the income statement. It underscores the importance of recognizing interest as it accrues over time, showcasing Meridian's effective asset management. The $200,000 cash collection reduces the loan receivable account, improving liquidity. ASC 326 emphasizes tracking these repayments to ensure accurate financial reporting. This inflow demonstrates the effectiveness of Meridian's credit policy, positively affecting the cash flow statement and reinforcing asset management strategies. ASC 326 requires periodic reassessment of credit loss allowances. Here, a $10,000 adjustment reflects improved supplier credit ratings. This reduction in credit loss expense indicates lower risk exposure and enhances profit margins, showcasing Meridian's proactive risk management and financial health improvement. Year-end adjustments like accruing $50,000 in interest income are crucial under ASC 326. They ensure the income statement reflects all earned revenue, aligning with accrual accounting principles. This reinforces the integrity of Meridian's financial reporting, providing stakeholders with a true view of financial performance. The settlement of the $800,000 loan receivable aligns with ASC 326's focus on accurate asset valuation and recovery. This final repayment confirms Meridian's loan management success. It replenishes cash reserves, closing the asset lifecycle, and highlighting the efficacy of Meridian's credit policies. Every Big Four and investment bank interview on ASC 326 follows a pattern. Here are the 10 questions that come up again and again, with answers that will make your interviewer nod. The CECL model estimates expected credit losses over the life of a financial asset. It allows for earlier loss recognition compared to the incurred loss model. This forward-looking approach uses historical, current, and forecasted information. A common mistake is confusing it with the incurred loss model. Remember, CECL focuses on expected, not incurred losses, enhancing financial statement accuracy. CECL was introduced to address the shortcomings of the incurred loss model, which delayed loss recognition until evidence was available. This proactive approach incorporates expected losses, improving transparency and decision-making. By using historical, current, and forward-looking data, CECL enhances credit risk management. Avoid assuming it's merely a regulatory change. It's a fundamental shift in accounting perspective. When an asset is impaired, the company records the expected credit loss by debiting a loss account and crediting an allowance for credit losses. This aligns with ASC 326's requirement for forward-looking estimates. A common pitfall is ignoring historical data in the calculation. Always remember, accurate forecasts require a blend of past, present, and future data. CECL requires updating expected loss estimates when conditions change. impacting the income statement and balance sheet. Adjustments are made to the allowance for credit losses and recorded as expense changes. A common mistake is neglecting forward-looking data adjustments. Remember, changes must reflect current conditions and forecasted economic scenarios to maintain accuracy. ASC 326 uses a lifetime expected credit loss model, while Indian accounting standard focuses on a 12-month expected loss unless significant credit deterioration occurs. ASC 326 is more forward-looking, requiring comprehensive data use. Misunderstanding these frameworks can lead to incorrect modeling. Memorize: ASC 326 emphasizes earlier and more comprehensive loss recognition. ASC 326 focuses on lifetime expected credit losses, while International Financial Reporting Standards 9 uses a 3-stage model of 12-month expected credit loss unless credit risk increases significantly. A key difference is the timing of loss recognition. Avoid confusing the models. ASC 326 is generally more conservative, focusing on lifetime losses from the onset. To calculate under ASC 326, combine historical loss data with current conditions and future forecasts. For example, if historical losses average $30,000 annually, current conditions add $5,000, and forecasts suggest a $10,000 increase, the expected loss is $45,000. A trap is ignoring any data component. Commit to considering all 3 data points for accuracy. Derivatives are excluded from ASC 326, which focuses on financial assets measured at amortized cost. The model targets loans, trade receivables, and similar assets. A common mistake is assuming universal coverage. Master this. ASC 326's scope is limited to certain financial assets, not including derivatives, which are typically covered under other standards. ASC 326 mandates disclosures about credit risk management, methodologies, and changes impacting credit loss estimates. Companies must detail risk characteristics and significant assumptions used. A frequent error is insufficient detail in disclosures. Remember, complete and clear disclosures enhance transparency and investor understanding, critical for maintaining trust and compliance. CECL integrates forward-looking information by requiring entities to consider economic forecasts in estimating credit losses. A common trap is underestimating its impact on estimates. Think broadly. Forward-looking data, combined with historical and current data, forms the basis of CECL estimates. Avoid focusing solely on past events. Future scenarios are crucial. ASC 326 primarily focuses on improving the timeliness of credit loss reporting. It covers financial assets at amortized cost, with an emphasis on expected credit losses over their life. Definitions like expected credit losses and lifetime ECL are crucial for understanding application. The standard applies to a broad range of financial assets, including trade and lease receivables. Historical experience plays a significant role in estimating ECL, ensuring current and past data are considered. The CECL model under ASC 326 broadens the data considered in estimating credit losses, incorporating both historical and forward-looking information. Economic conditions, both current and future, are integral to these estimates. All calculations are as of the reporting date, and forecasts must be reasonable and supportable. Asset-specific characteristics significantly impact loss estimates. Regular reassessments ensure that estimates remain reflective of current conditions. Interview candidates should remember that improper handling of forward-looking data can lead to errors in credit loss estimates. ASC 326's forward-looking requirements distinguish it from ASC 450. Essential disclosures cover methodology and assumptions. Loss estimation for complex assets requires careful consideration. Implementation challenges abound, notably in data handling and forecasting. The financial impact is notable, with increased allowances affecting statements. Auditors will scrutinize assumptions closely, and system updates might be necessary. That's your complete guide to this accounting standard. If this video helped you, please like and share. It genuinely helps us keep creating content like this. Drop your standard requests in the comments. Subscribe to Candy Mentor for more accounting and finance videos. We'll see you in the next one.